Hey, welcome back, everybody, to today's Market Explained. I'm Brian Castle. I'm your host, and we will do our standard program today where we'll talk about the markets, we'll talk about the economy, and then we'll talk about what we see out there in the world. I have with me today my regular co-host, Mr. Chris Reardon. Chris, welcome to the podcast.
Yeah, glad to be here. Good afternoon to everyone, and glad to talk a little bit about the markets.
Yeah, and Chris is the Director of Development of FourStar Wealth Advisors, headquartered out of Chicago. And he's a Cleveland boy, still likes his Indians. He's got a young family. And how many? Three young kids now, Chris. Wow.
hmm
Oh, boy. Anyway, but he's does a great job as our Director of Development and a savant on the markets again. So, Chris, welcome.
Yeah, thank you, Brian.
And I'm the founder and CEO of FourStar Wealth Advisors in Chicago, headquartered out of Chicago, a national firm with 40 plus advisors and $1.3 billion in assets. I'm the advisor to many insiders and public companies, financial advisor for 41 years, and also chief dad to Evan and Quinn and husband to the amazing Tripty. So happy to be your host and welcome everybody to the show. Thanks for being with us. Chris, why don't we start out with what the markets are doing today? But before we do that, let me just say we just noticed they elected a pope, the first American cardinal that has been elected pope. So we'll hear more about that. That's an interesting development, important leader in the world. Even if you're not Catholic, there's a lot of people that look to the pope for guidance or others who talk to the pope. So that's just emerging as we begin taping today, Chris. How about that?
Yeah, crazy. I mean, I think the last podcast we taped, they were just going into, or they were just kind of starting kind of the process, the ceremonies, for the prior Pope step. So it's really interesting that the way it lined up.
Yeah, exactly. But anyway, well, good. Well, tell us what's going on in the markets. Maybe the Pope's moving the markets.
Yeah, I mean, interesting with the markets right now. So commodities are still leading. They're the number one position, but it's actually lost 9 points from the last podcast. That was about mid-April. So it's at 241 tally points. And commodities are really interesting. I mean, it's a very kind of tale of two sides there, where you have gold. Obviously, the precious metals have maintained and been very strong, and even some of the agriculture has been very strong. You've had that side, but then you've also had the flip side being oil and industrial metals. And a lot of those have faltered really as of late, just because of the potential for decreased demand with the tariffs and this kind of potential recession that everyone's kind of predicting, things like that they're seeing out there. So commodities net we've seen a pullback since the last podcast. Domestic equities, conversely, has really held pat in that number two position. It's at 235 and plus
Okay.
one. So now it's really within striking distance, within 6 points of retaking that number one position from commodities. So it's a
Uh,
really interesting thing to keep an eye on, in the next week or two, because we could see that flip.
okay.
International equities was the biggest winner. It gained 21 points since the last podcast, and it's at 209 tally points. So that's another one that's kind of pushing back up into that number two or even one conversation position. So we'll see how that plays out. And then as we get to the bottom three, cash was minus 11 since the last podcast at 154 in the fourth position. And currencies was in fifth at 136 plus one. And fixed income is in last at 112 minus 2 points since the last podcast. So not a whole lot of change. I mean, in those bottom three, the biggest move obviously being from cash, which overall is a good sign. That cash was kind of losing some points, seemed to be getting picked up mostly by international equity. So we're seeing some kind of flows there on that front.
Great. So the mini trend is domestic equities are a little better, international equities are up big, and that's probably a sign of the dollar being weaker, isn't it, Chris?
Yeah, I mean, I think it's the dollar being weaker for sure has definitely helped, and I think some of the economic numbers we've gotten out of Germany has had some good economic numbers, and we'll talk about it a little bit later, but the lowering of interest rates there, the currency differentials, that certainly helped a lot of those as well.
All right. Okay. All right, well, that's good. And then, the sectors for the year that are acting well, technology was down big, consumer discretionary was down big. Now they've rallied. They're still down on the year relatively, but healthcare, utilities, consumer staples have been the best because we've been in kind of an expected protracted downturn in the economy. We're starting to see the recessionary numbers come through, and then still some positive numbers too. So there's kind of a swirling set of things going on. There's positive numbers, but yet the economy is still slowing down in certain material ways as we reduce spending across the board. So we're still kind of where we were, but we've had a reversal where technology has been rallying again, and some of the names that were doing better are, last week or so have not been that strong. So, but Chris, where are we now with the economy?
Yeah, well, and one thing, couple things that from just even the general markets that I'll just mention, we and kind of leading into that is the Federal Reserve opted to maintain rates. This was actually just yesterday, and they highlighted the risk of stagflation. I don't think there was any surprise to this from the general economy, I guess. I think the expectation was that they would hold rates pat, and I think that's kind of the right move. I think lowering rates here, there's more risk than reward with what we're seeing, but they really are taking kind of a wait and see measure on that approach. And then the biggest news today that's causing another rally in the markets is we are seeing the US and UK kind of announce their trade agreement. I think we're still waiting for some of the details to come out and be hammered out the next week or two. But this is a big deal. This is the first kind of official announcement of one of these, and I know there's talks that something with China is in the works too, so a lot of other countries. So this is good, and this is also good just as far as kind of really starting to hopefully smooth out some of this volatility that we've really seen these tariffs cause the last almost 2.5 months now. So that'll be really big to see. Hopefully, once that releases, it's positive, it's good, and we can kind of start to move forward a little bit from there, kind of piece by piece. So,
Exactly.
um, as far
Well,
as go ahead, Brian.
well, now the economy, inflation is down since September, so that's a positive, right? And then Chris, they reported GDP, right? You want to walk through that?
Yep. Yeah. So as far as the economic numbers, if you will, the Q1 first GDP number, remember they make several kind of revisions or adjustments after that, but the first read for Q1 GDP came in at minus 0.3%. So obviously, two, that's the first negative read. If that stands, could be adjusted back up, could to be flat. We'll have to wait and see. But if that stands as a negative, if the next read, so if their Q2, which we're now ends up being negative as well, that would be two consecutive quarters of negative GDP, which would be the official definition of a recession.
Hmm.
So that's kind of the first stage, if it stands, of a potential recession there.
Hmm.
But we'll have to see. I think one of the things with it is it was kind of that tail end of the tariffs, kind of, so they don't really fully have an impact there. So Q2 will be definitely more interesting. And even though the tariffs could have a net negative, um, as we'll see, we kind of saw the month of March and even beginning of April,
Hmm.
we saw an actual pop. We could see even a kind of abnormal pop in GDP as people were trying to bring in goods, produce goods before the tariffs took effect. So there are
Right.
distortions that could happen there. But and going
So
going go
So, so Chris, the GDP could have been even worse if not for that mini trend of people panic buying because of the tariffs.
Yeah, yeah. I mean, we could have seen that, and I think that's going to create more havoc or distortions. I would say we certainly saw it towards the very tail end of Q1, but I think where we saw it more was probably in the beginning of Q2. So it'll be interesting to see the impact that potentially has. Yeah, as these
Yes,
do get revised. So
exactly. Okay.
and one thing, one number I think that points us out probably kind of proves this point is the March durable goods orders came in at 9.2%. So that shows kind of that trend. I mean, that's a huge
Mhm.
jump. Usually, I think the previous one was like 2.3%. So we're talking a huge multiple of that. And this is because businesses are trying to kind of front run, if you will, the tariffs, get in front of them,
Hmm.
get things imported. So it'll be interesting to see how that kind of plays out. Um, the initial jobless claims for the last full week of April came in at 223,000, which is
Hmm.
right in line with expectations.
Hmm.
And then the April non-farm payrolls came in at 177,000, which was actually well above expectations, which were 130,000. So that's really good to see. It seems like the job market is holding up better than expected, which is positive. And I think we're seeing this. We've talked a lot about this, where we definitely have this. There's some positives and some negatives. So,
Yeah.
it's kind of which is winning out on the consumer sentiment side, if you will. Um,
And and expectations though had been lowered quite a bit, but then they beat the lowered expectations, right?
Exactly. Yeah. I mean, expectations for the non-farm payrolls were 130,000, so they did beat. But and it's still 177,000. I would say on average, we're usually seeing about a 220 thousand or so. Was actually kind of on average. So it's down a little bit. But 177 is still a strong read. So that
Mhm.
was a good read for the US economy, that people were still hiring. Switching paces to the kind of housing market, March new home sales were up 7.4% from the prior month. So we're starting to see a little bit of a pop in new home sales, but existing home sales were down 5.9% in March. So kind of an interesting trend there. We're continuing to see a tightening in existing home sales, so we're not seeing as much kind of flip as
Mhm.
people leave or moving out of their existing home, purchasing a new one. We are seeing some purchases of new homes, so that's good for the builders overall. But one interesting trend that I saw is monthly home prices year over year. They were up 3.9%. So we continue to see home growth as far as prices. And that was in February, which was down 5% in January. But the trends we're seeing there, the sub trends, if you will, are really interesting. We're seeing kind of a reverse trend that we saw just after the pandemic. So after the pandemic and even during, we saw this flight to southern states, Florida, Tampa, Austin, Texas. We saw this flight to warmer weather and all that. And we've seen a reverse of that in the last year as far as home prices. So those prices in Florida, in Texas, got bid up really high. In the last year, they've actually come down. They've been the worst. They've seen the biggest decrease, if you will, in their prices. Whereas the biggest increases now are coming from kind of the New York, Connecticut, and even Chicago, kind of the northern states. I've seen kind of the biggest pop, in their home prices. So we've seen a reverse trend, which is really interesting, and it'll be really interesting to see how that plays out.
Exactly.
Going over to sentiment, the University of Michigan's final April consumer sentiment read came in at 52.2. That was up slightly. It was kind of pushed up a little bit from the prior estimate, but still, obviously, 52.2 is low. So that's something we would like to see trend-wise move upwards. And hopefully, if we do get some more resolution to these trade agreements and tariffs, we'll start to see that inch back up. Flipping over to the last thing we'll flip over to is inflation wise. The PCE price index came in at 2.3%, which was right in line with expectations. Well, it was slightly 2.2% was expectations, but um, was right there. And then the core PCE, so that excludes fuel or fuel, things like that. That was right in line at 2.6%. So, as far as the inflation reads we've seen so far, the inflation has so far maintained in check. I think the biggest thing is going to be what the inflation reads are in the next month or two, and if we see those numbers start to tick up. So we'll have to keep a
Yeah.
close eye on that.
Yes. All right. Well, good. Chris, if I could just comment again about the job growth. The thing about job growth, you mentioned that, it's been still positive. Now, some of the changes that I've been able to uncover, most of the job growth in America was focused on people from outside of America getting jobs. That has now shifted where most of the jobs are American-born workers getting jobs, not foreign-born workers. Also, different in the numbers is government employment is down for the third straight month, which is a positive development because government had been so bloated and hired so many people, much more than needed, and running massive deficits. So the recent administration team has come in, as everyone knows, to cut waste and abuse, and also cut so many jobs, government jobs, and many of the people that we found in government weren't even coming into the office. Only 6% were coming to the office, and many were at home. But many who were at home really weren't even working. So government employment got a little bit out of control under the last administration. So now they're cutting a lot of that inefficiency, waste, and bloat. So now that's why we're seeing government jobs down. Um, so despite all the tariff controversy, which has not yet been resolved, employers are still hiring, but the hiring is natural born citizens and in private sector jobs rather than government jobs, which I think is a really important development, Chris.
Yeah, I mean, obviously, that's the best as far as hiring. I mean, government jobs, there's always that kind of asterisk, if you will, to it, because government jobs are paid for by taxes and things like that. So it's kind of it's not as a net positive as
Mhm.
private payrolls, non-farm payrolls, things like that. So it's definitely, I think, a positive overall. But it'll be really interesting to see how that, I think you brought up a good point as far as these anomalies, one being the government cuts, and the other one being these tariffs that are really rippling through. So I mean, I think we have probably about, maybe 6 months or so.
Mhm.
Who knows how long in actuality, but let's say 6 months of really, it's going to be wonky or odd numbers, just because these are going to have to ripple through. You're going to have greater than normal layoffs potentially because of all these government cuts. You're going to have
Mhm.
obviously abnormal imports, exports because of the tariff. So, once these start to ease out, I think we'll start to get a little bit better of a picture, but it's definitely going to muddy the water per se.
Yeah. Yeah, it's a very confusing time. The many things that we're seeing now that we've never seen before. We've never had an aggressive tariff regime like this before. So, numbers will be what they are, but there will be positives and negatives, and they're all going to swirl into a set of numbers that we're going to try to analyze and see if we can make sense of. Um, and then one thing we noticed on the unemployment side too, Chris, since we're in a slowdown, we're noticing that time that folks being unemployed has risen, right?
Mhm.
So now, people are unemployed for longer periods of time, and consumer spending was up 4% in the previous quarter. It's still positive, but only about 1% now. So the rate of growth has slowed for consumer spending. So it's decelerating, but still positive. Prices were the same in March. So again, here's all these different kind of positive shoots, negative shoots, and again, we'll keep trying to sort out what it all means and what the aggregate numbers are. It's likely that the GDP numbers come down for the next couple of revisions for the first quarter, because
Mhm.
usually when the trend is negative, usually the follow-up revisions are in the same trend most of the time. So we'll see how that shakes out.
Yep, 100%. Yeah, I mean, I think that's a very good point. I think as far as the jobs, I think that yeah, that's a good point. I think that a lot of companies are kind of stalling their hiring plans. I think we still saw, obviously, non-farm payrolls came in higher, so there still was hiring, but I think that is starting to slow down. So I think the good thing with that is we're not seeing a bunch of layoffs necessarily from the private side yet.
Mhm.
There are some industries. I know UPS was one. There's a couple of ones, but not a lot, not as much as we've seen in the past. So that's positive. But I think to your point, Brian, that's going to show if there's people aren't hiring as much, there's going to be people who are on unemployment are going to be on there longer before they can find a job.
Exactly. Okay. Anything more on the domestic side, Chris?
No, that
Okay.
covers it.
All right. So I wanted to talk a little bit about China. So now that we're in the middle of this set of tariff realignment, just today it was announced the UK has struck an arrangement with the United States on tariffs, and there'll still be some tariffs in place, but they've reduced a lot of different barriers that were in the UK. That's what was Trump's objective. And of course, our society was developed out of the UK, with many of the patriots coming from England, obviously, to form. So we have a tight relationship with the UK, even though sometimes we don't agree with them. But they were the first ones to make their final agreement with us. I know they're close on India, they're close on Japan and some other countries. China, despite their rhetoric, and they've been really the bad actor in this process because they've been being very, very obstinate. But despite the rhetoric that they would go to the wall and never compromise with America, that was a couple of weeks ago, managing tariffs and uneven trade, they're now actually making moves and putting out feelers about managing fentanyl production, for example. Yes, yesterday President Trump was asked whether China would be okay to continue to produce fentanyl, and he said no, just flat out no. They've got to stop doing it and stop sending it to America. So most of the fentanyl in the world was created in ingredients and in China and sent to other countries like Mexico, and the cartels are the ones that traffic those drugs into America. Trump wants that stopped. So it's not just pure economic reasons they're doing tariffs. They're always also looking to solve things like the drug problem that's coming in and the border. So we're trying to even, get the source in the South. They've reached out to the administration to see what they need to do. So they're looking like they want to solve the tariff issue, but there's still a little bit of bluster for the local people. So for many of the leaders in the public, they continue to show that bravado that the Chinese Communist Party, the CCP, shows. But privately, they're actually starting to make the changes from what we hear in the administration to negotiate and get their economy out of what is, Chris, now a complete collapse of the Chinese economy because they did so much business in and out of America, and so it's really bad. And I think Trump knew eventually they would come to that. For a couple of weeks, China was actually bullying other countries to cut off trade deals with them between them and China if they were working with the US. That seems to have subsided as well. So previous tariffs on China were met with goods coming through China, through Vietnam and other countries. And so that's the way they got them in. So now the Americans are aware of that. So anyway, it seems like the tariff movement, while not as quick as everyone would want it to be, seems to be working for the most part now. And so everybody will redo their deal, and then hopefully we get back to doing normal trade. So that's kind of how we see it right now as far as the tariffs. Anything else on that, Chris?
Yeah, I mean, I think that it'll be interesting. I mean, I think China right now, I think they've said they're going to kind of come to the table, if you will, and have those discussions. I think a little bit more in depth. So there is hope that this will kind of there'll be an agreement that both sides will agree to. So we'll see. I mean, I think that we don't know. Maybe their demands are unrealistic. Maybe their offerings are unrealistic. But it is good that at least we're having a conversation out there. That's at least step one, and hopefully they can kind of come to an agreement. There are two things I should say I'll add. From the international front, at least, is recently, as of today, actually, we had the Bank of England cut their rate to 4.25% from 4.50%. So, we're not in a vacuum per se. So other countries, other central banks are, trying to manage their own economy. So we're seeing the UK lower their rates, and we'll probably see off of that. I think what we're seeing today is the dollar strengthen off of that. We're seeing the pound weaken. So that'll be an interesting thing to watch. And then going to China, one of the things that they're enacting this week is they're cutting their interest rates and injecting more liquidity to help kind of bolster the Chinese economy against some of these tariffs, because as you said, Brian, that is certainly going to hit their economy hard. So a couple of things they're doing, they're lowering the reserve ratio for Chinese banks, so that'll allow them to lend more money. That's that liquidity aspect. And then they are going to cut the kind of short-term rate for repo or repurchase agreements by 0.1%. So we'll see. I think it's hopeful. I think once we start to see these agreements kind of come out, it'll also be how long does it take? Because supply chains, things like that, don't unwind overnight. So is it going to be a 2, 3, 4 month kind of lag, a hangover, if you will, once these agreements kind of get put in place, and kind of a renormalization of trade?
Exactly.
So
Well, great. So, on a positive note, one of the things that President Trump was looking for is he was looking for countries, instead of manufacturing overseas and being tariffed, is that they would say, let's move some manufacturing back into America. Now, some are resisting a little bit, Japanese with their cars and stuff like that, but they're working through those things. But they've announced now over 8 trillion, the number keeps getting larger, of new investments in the United States just since the tariff regime on that Liberation Day was announced. So that's only a month and about 10 days ago, actually, not even. So it's pretty amazing, the stuff that's been announced already. They're also saying that they estimate about 700,000 new jobs are coming into America, and much of it in manufacturing. We had let our manufacturing base go in America dramatically in the last 30 years. There was a whole trend there where many of our leaders were, in their minds, globalists, and they're trying to help out the world. There was a trend to democracy, obviously, in a lot of countries as well. And so, along with democracy, folks were hoping that there would be capitalistic trends as well. That's kind of part of the elements of the whole American experiment, which has turned out to be the most successful experiment in world history. So democratic elections in a republic form with capitalistic government. And so we've seen some of that, but yet there had been big barriers in certain areas where there were certain countries were protecting certain industries. So Trump wanted to reduce those barriers, and that's what's going on. So as a result, 8 trillion in new investments, 700,000 estimated new jobs. It's probably only going to grow. So while we're seeing negative things from the backing out of all the government spending that was running $2 trillion deficits for the last 3 years in a row. So that spending is coming down, government spending, government employment, that's all coming down. At the same time, we're seeing the private sector grow and expectations for it to grow. So that's the feeling we're getting, is that even if we have a recession, as you said, Chris, 2 quarters in a row is of negative growth is a recession. Even if we have a recession, our sense is that it might not be as severe as some previous recessions like 2008 and others, because of this other trend coming in the other direction.
Yeah, I mean, exactly. And I think one important thing is, not only do you have the job growth, have those jobs, industries coming back here, but the innovation. I mean, I think that when people think about, oh, the tariffs and what they're going to do, and do we really want, you think about these Chinese like these sweatshops, I guess is what most people kind of picture, people, um, you know, why would they do that? The cheap goods. Well, why can't we have innovation over here? Why can't we automate a lot of that? I mean, there's so much that when you kind of give companies a shove to make them say, hey, let's just break this norm, that they can go to the drawing board and say, all right, well, we can do it here in an efficient way, at a cost-effective way to us, without having to overpay, and still having those jobs, and not only having those jobs, but jobs that are controlling the manufacturing process. I mean, good high-paying jobs. So there's a lot to be gained, I think, from it. As this kind of uh, trickles out.
Exactly. Well, it's interesting. While we don't know as much about what all these tariffs are going to do, we're seeing some of the effects of them, and it does appear to be long-term positive, maybe short-term disruption, as we mentioned before, but it looks like it's going in the right direction, Chris, wouldn't you say?
Yeah, I mean, I think that there's promising signs. There still is a bit of a way to go, but I mean, the fact that we have an agreement, the bones of an agreement, I should say, with UK, is good, and the fact that we've had, I know from what the administration said that there are talks there. I think we've talked about this on the podcast before, I think in the previous episode or two, but the issue right now with the markets that causes is the extreme volatility and the uncertainty. I mean, that's the biggest thing impacting the markets right now.
Mhm.
So once we get some clarity to that, we'll see that volatility tamp down, and we'll resume some growth. And as we talked about before, hopefully there'll be more U.S. jobs, that'll be more innovation. We'll see kind of what the U.S. needs to really grow and move to the next phase, really.
Yes. Well, that's great. Well, we don't see a lot of other economic numbers coming out here for the next week or so that are important. We saw the Fed didn't lower rates as President Trump had wanted, so they're still holding out to make sure that they understand if the inflation is under control. But Chris, in the "What are we doing about it" segment, so we had a really tough, almost 20% decline in the stock market from the highs of January. The markets got very, very sloppy. And so then the FourStar models have rotation features to them. So our models, through a series of indicators that got to the negative side, we quickly raised cash. We have four different signals that would get us from fully invested to a maximum cash level. And we got those signals about a week prior to President Trump's Liberation Day. So then when the markets went down 5.5%, 2 days in a row, clearly we were very well protected. We had the protection plan fully in place, and we sat there for a couple of weeks. Then we've had 9 days of rally up until Tuesday of this week when the market pulled back, and so we started to get some of those signals to turn to get us back into the market. But when we have a reversal like this, we need to see more evidence that it's going to continue. So we moved about two of the positions out of the four we could have back into the market, and then we'll wait and see for more evidence to see if we could put the rest back in. Only about half of the time that we come off the bottom and are fully protected do the moves end up being positive. Sometimes we have to get back out again, that they're false moves. And so it's unclear to us as to whether they're strong moves and they're going to continue or not. So we just watch for the evidence and try to take advantage of that. The good thing about doing this rotation model program is that because folks didn't sustain the big declines in their portfolio, they had heavy cash. They see much less volatility in their portfolio because we raised cash. And that's an important function of that protection plan. So most of our investors did not suffer a huge decline, maybe a third of that decline, but not the full decline from top to bottom. And if we did bottom, 10 days ago or so, Chris, well,
Mhm.
then now some of our people are getting back in. We often don't know that a bottom is in for a couple of months until we get the right evidence that the markets really are in a sustained uptrend. So we just have to watch and wait, Chris, don't we?
Yeah, I mean, I think each market kind of cycle or decline and bottom is different. And this one certainly is so. I mean, there's a lot of brand new things, the tariffs, as you've mentioned, Brian. I mean, the government cuts. So uh, I think a lot of people don't really know what to expect. Maybe we are at the bottom, maybe we're
Mm-hmm.
not. But I think the wait and see approach that we've kind of taken, and we wait to see that those indicators of ours really start to turn up. Um, I think is the way to go because we don't know for sure.
Right. Well, and by doing it the way we do it, we get to a point. There's so many things about the economy that you could learn, and now there's so many things about the economy that no one understands, like tariffs, right? So all these economists are all predicting what's going to happen, but truth is no one's ever seen this before, and so we don't really know what's going to happen. And then how can you make decisions because you don't have the right information? So people sometimes feel frustrated and flat-footed about the lack of knowledge. And the joke in the economic world, and my background, all economics from University of Chicago, is economics is the dismal science because there's so many factors that no one can ever really know what's going on. And that's in large part very true. So the good thing though is that we don't buy economic numbers. We don't buy unemployment numbers. We don't invest in GDP numbers. We invest in stocks and bonds and real estate and other alternatives. And all we really need to care about is what those things are doing. So if the markets are rallying and a sustained rally, we want to be fully invested. And if they're very choppy and trending negative, then we'll take some protection. So that's what we watch. We
Mhm.
watch what the markets are doing. We follow trends. And the market votes every day. All the people who are out there are buying or selling or doing whatever they're doing. And that's the voting mechanism on what the news is doing to the economy. And so that's how we follow it. And so that's how we have the comfort of realizing that we don't have to know every little detail about the economy. We certainly can understand it, learn more as time goes on, but you don't have to be an economic savant to be able to manage portfolios. You just have to watch what you're investing in and what it's doing and what signals the markets are telling you. So that's what we do, Chris.
Exactly. Yeah. I mean, I think that's the best way, in my opinion, instead of trying to be
Mhm.
predictive or try to run it, analysis. And I think is we just follow the patterns.
I think Yogi Berra had a comment about predictions that sometimes they're not true, something
Yeah.
like that. Yeah. Anyway, so Chris, other kind of noted things about what we see out there. Um, I had one item I wanted to bring up that we're seeing some big changes also that obviously could be economic related with health. Robert F. Kennedy is now the new HHS Secretary, Health and Human Services, and they're banning many levels of yellow and red colorings due to foreign substances that are in there. Many aspects of the American food system have been somewhat toxic, full of sugar, full of additives, things that are not allowed in many other countries. So they're making some big changes. And so that's a big positive. We're seeing some more and more announcements there. Obviously, it's rankling some of the food industry because they've been able to put all those additives in there. I recently spent a week in Italy, and the wines don't have sulfites in India. Or I mean, sorry, in Italy, not India. Not sure about India, but certainly not in Italy. So the headaches that you might get from a glass of wine, don't happen certainly in some other countries. So I just noticed it just from that. Chris, I know you had some other interesting things in what you see out there.
Yeah, I mean, I think one of the biggest ones right now is talking about India, we're seeing tensions flare between India and Pakistan, and we've seen a kind of, as a micro attacks, but small little strikes by both countries now on each other over some kind of terrorist killings that have occurred, and kind of one country avenging the other. Pakistan originally had some terrorist attacks that happened in India and killed some Indian civilians. And then India retaliated on Pakistani soil. So that's something obviously to watch. And we're seeing tensions continue to escalate there. Hopefully that takes a turn and starts to de-escalate. But that is certainly something that could have a global impact. And then finally, Warren Buffett, the sage of Omaha, finally decided to throw in the towel and retire and kind of settle down in Omaha there. So that's obviously very big. I think a lot of people are wondering how his fund is going to continue on after he fully leaves. But that's definitely the end of an era for sure within the Wall Street and finance in general.
But he'll stay on as chairman, right?
Yes, he's going to stay on as chairman. He's just not going to be CEO and running it.
Excellent. Well, then one of his good buddies is Bill Gates and the founder of Microsoft. And Warren was the richest man in America, in the world. Bill Gates was for a period of time. Of course, now it's Elon Musk. But Bill Gates announced just yesterday that he will give away substantially all of his fortune to charities and other organizations by 2045. That's big news. There's a lot of money there. He's in the 70 billion range, something like that. So it's pretty big money. And Warren Buffett and Bill Gates have been friends for years, and of course, both helping get rid of their net worth and not passing it just to family, giving it to other organizations and charities and any other organizations that they feel that would be necessary. So giving away most of their wealth. Um, and then the Interior Secretary for the new administration, Doug Burgum, who's the former governor of the state of North Dakota, talked about how they're going to be starting mining and drilling again in America. So, what is that? MAMA, Mama, Make America Mine Again. And then MADA, Make America Drill Again. So they're actually going to be opening up lands that were previously cut off by the previous administrations for oil drilling in America and mining again. Obviously, there's concern, which is why some of those areas were cut off for mining and drilling, to make sure that we don't have oil spills and bad environmental events. And of course, they're very focused on that to make sure they don't. But this administration's view is let's use our resources and not just be scared of spills. So let's use them and make sure we do it right. So Doug Burgum is leading that whole change now, and we're kind of turning back from the Biden administration's view of it.
Yeah.
So
Yeah. I mean, I think it's important to note. I mean, you still had the demand and the want for companies to drill and create new wells and mine. The key was just kind of roadblocking them, right? Not allowing them to buy any land or mine, or cutting off access, making it essentially not profitable. So by opening that up, I think we can let the market reign. And you know what? If oil's not profitable, if it's $50, $40 a barrel, we're not going to see many balls. But once it pops, once we see that spike, we'll see that. And, we'll let the market kind of decide, which I think is the best way.
Yeah, exactly. Well, and one last trend I just thought I'd highlight as well, along with other government efforts now to limit spending and eliminate bias in government, the Trump administration is cutting all funding for organizations that are seen as being very partisan. National Public Radio and the public broadcasting system has now been widely seen as, for very left-wing, more ideologies rather than broad-based news. So they're trying to get everything to be nonpartisan, not conservative either, but not certainly left-wing either. So they're trying to reduce spending for all the partisan-related sources. They're even making changes to Voice of America, which was the radio stations that would broadcast into communist countries, for example, when the news was coming through, was mostly propaganda to those people. But some of that has seemed to take a partisan trend as well. So they're trying to get rid of that kind of spending. Now, it's not illegal to do that. Private sources want to fund ideologies on either side, they can, but then our taxpayer money shouldn't be going to one side or the other. Let people fund that on their own. I think that's a good trend. And it shouldn't be, like I said, conservative or liberal. It should be just nonpartisan. So,
Mhm.
excellent. But so there's a lot of other things going on, but I think for now, Chris, I think we'll leave it there, huh?
Yeah, I mean, I think that's a lot to digest, but I think that covers the big points.
Absolutely. Well, and folks, look for other interesting subjects. We just made a post to the leadership matrix. If you go into fourstarwealth.com, you can see the leadership matrix. We bring lots of interesting subjects on there about the tariffs and other things. We posted it, a number of other interesting posts this week. And you can sign up to get regular copies of the leadership matrix sent to your inbox. So feel free to go in there and have a look. Also, we're going to be doing some more podcast interviews as we get into the spring and the summer. Very soon, we're going to have on behavioral finance expert and former pro football player Joe Hart, who's going to be talking about how people think about their money and why people make so many mistakes, unfortunately, when they do manage their money. So we will be hearing from Joe here very soon. And I think that's it for today, Chris.
Yeah, I think that covers it. So thanks everyone for listening.
Thanks, everybody, for being with us. We'll leave it there. This is the FourStar Today's Market Explained. Signing off for the day. We'll be back again very shortly with another episode and give everybody another insight as to what's going on in the world. Thanks, everybody, for being with us. Over and out.